All right, let's just jump right in. We are going to pull back the curtain on a part of the financial world that, believe it or not, quietly controls almost everything. We're talking about the rate on your mortgage, the health of your 401k, the whole shebang. So yeah, today we're demystifying the bond market. Look, you've probably heard it a million times, right? Stocks, crypto, the hot new IPO, that's where the real action is. But what if I told you the true financial heavyweight? I mean, the market that really calls the shots is something most people just kind of dismiss as, well, boring. And the numbers, they just don't lie. We are talking about a market that is worth over $100 trillion. Just try to wrap your head around that number for a second. It's so massive, it's hard to even picture. This isn't just some big market. It is the absolute bedrock of the entire global economy. So why on earth should you care about this supposedly sleepy, boring market? Well, because as we're about to see, it's the one that truly matters. It influences every single part of your financial life, whether you realize it or not. Here's the best way to think about it. Bonds are like the thermostat for the entire economy. Seriously, they set the cost of borrowing money for everyone, for you, for giant corporations, for the government. And when that thermostat gets adjusted, we all feel the temperature change right in our wallets. Okay, let's get into the nitty-gritty here. What exactly is a bond anyway? It sounds complicated, but I promise you, it's actually much, much simpler than you might think. At its very heart, a bond is just a fancy IOU. That's it. When you buy a bond, you're not buying a piece of a company like a stock. Nope. You are simply lending that company, or the government, your money. And in return, they promise to pay you back with interest. It's just a formal loan. So first up, you have the principal. This is the easiest part. Think of it as the original loan amount, the big chunk of cash you're guaranteed to get back when the loan is due. It's often called the face value, maybe $1,000. Next is the coupon. Now, this is your reward for lending them your money in the first place. It's a fixed interest payment you'll get on a regular basis, maybe once or twice a year. So if you have a $1,000 bond with a 5% coupon, you're getting a nice, predictable $50 every year. Simple as that. Then there's maturity, and this is just the end date of the loan. It's the exact day the issuer pays you back your original principal in full. This could be in 1 year, 10 years, or, hey, even 30 years down the road. And finally, we get to yield. Okay, now this is where things get really interesting. The yield is the actual return you get on your investment. And here's the key. It's not always the same as that coupon rate because the price you pay for the bond itself can go up or down. So always remember this. Yield is what you actually make. This whole idea of price changing brings us to the most critical, most important dynamic in the entire bond market, what I like to call the financial seesaw. It's this constant, powerful push and pull between bond prices and interest rates. This little chart shows you that inverse relationship perfectly. So imagine you own a bond that pays you 4%. Pretty good. But then, all of a sudden, new bonds are being issued that pay 6%. Well, your older, lower-paying bond isn't so attractive anymore, is it? So to compete, its price has to fall. But on the flip side, if new interest rates drop to 3%, your 4% bond suddenly looks amazing, and its price rises. It's a seesaw. Let's actually put some real numbers on this to make it super clear. So we've got a $1,000 bond that pays $50 in interest every year. Now, if you can snag it for a discount, say for $900, your actual return, your yield, jumps up to 5.56%. But if you have to pay premium for it, maybe $1,100, that same $50 payment only gets you a yield of 4.55%. See, the price you pay directly changes your real return. Okay, so we've covered the mechanics, the nuts and bolts. Now let's zoom out and see how this seemingly simple seesaw effect creates these massive ripple effects that control, well, just about everything in the economy. It all starts right here with US Treasury Bonds. These things are considered the safest investment on planet Earth, what everyone calls the risk-free rate. The yield on these bonds basically sets the baseline price of money. It creates a benchmark that every other type of loan or debt is measured against. And you can see that ripple effect directly in your wallet. The yield on the 10-year Treasury note, yeah, that pretty much sets your mortgage rate. Shorter-term Treasury yields, those affect your credit card rates. And as we're about to see, when bond yields get high enough, money starts flowing out of riskier things like stocks. It even funds the government itself when taxes aren't enough to cover the bills. So let's connect all these dots. Why does understanding this complicated-sounding market actually matter to your personal financial health and, the economy as a whole? Think of it like this. Stocks are the drama queens of the market. High potential, but also high risk. Bonds, they're the steady hand, a predictable lower risk loan. So when the yield on that steady hand gets high enough, let's say you can get a guaranteed 5% risk-free, investors start to ask, wait a minute, why am I taking all this risk in the stock market? And that's when money moves from the drama queen to the steady hand, and you often see the stock market fall. Now let's talk about the government. Right now, the US has a debt-to-GDP ratio of about 122%. So what does that even mean? It means the country owes way more money than it produces in an entire year. And how is all that debt financed? You guessed it, by issuing bonds. And the consequence of that is pretty straightforward. When interest rates and bond yields go up, the cost for the government to pay the interest on its massive debt just explodes. That money has to come from somewhere, right? And eventually, that translates into some very tough choices. Higher taxes for you and me, or cuts to things like public spending. So the bond market isn't some dusty, boring corner of finance. It is the steering wheel of your financial future. And ignoring it, that's like letting someone else drive your car while they're distracted, scrolling TikTok. Understanding the force that literally controls the cost of money is the first step toward taking control of your own financial destination. The real question is, are you ready to take the wheel?